Good evening. Tonight we're going to talk about two of my favorite subjects, death and taxes, but mainly taxes. So before you die, you're going to have to pay the US government a lot of money, but maybe not as much as you thought. So let's break down how taxes actually work for US residents and how it's relevant to investors. Before we get started, though, quick disclaimer. I am not a certified financial guru advice person. I can't advise you personally on your own investments. I encourage you to always do your own research and make your own decisions. Let's dive in. All right, so basically, there are 7 categories of income or assets that people commonly think about: wages, salaries, and tips, which are ordinary income; bank interest and corporate bonds, also ordinary income; short term capital gains, you guessed it, ordinary income; long term capital gains, preferential capital income; qualified dividends, preferential capital gains; non qualified dividends, which are, again, ordinary income; and municipal bonds, which are tax exempt. So, 7 common income asset categories that people think about, but in terms of tax classifications, there's actually only 3 categories: ordinary income, preferential capital gains, or tax exempt status. Now, there are different federal tax treatments for each of the asset categories, though. So your wages, salaries, and tips, they're subject to progressive marginal tax brackets, or at least they were until recently. Some tips were exempted from that, so they can be received tax-free. And your progressive marginal tax rate goes from 10% at the bottom to 37% at the top, which sounds scary, but I'm going to break that down in a minute. It's not actually that scary. Um, Not all of your money, if you're in the upper income bracket, is taxed at 37%. It's only after you get past each threshold. And I'll show you a concrete example of how that works. So, your bank interest and corporate bonds are taxed at your highest marginal bracket. So, those come on top of your ordinary wages, salaries, and tips. They stack on top of that like a pyramid. And then your short term capital gains are taxed at your marginal bracket. And that applies to assets sold after being held for 365 days or less. If you hold things for the long term, it can work for you if you're in a higher tax bracket, because that's capped at 20%, depending on your taxable income. Then you've got your qualified dividends, which are exactly the same as preferential capital gains. I'm going to have another video coming up soon about how dividends actually don't make a difference in terms of assessing the quality of stocks or investment in general, but that's another topic for another night. And then you've got non qualified dividends, which are taxed at your marginal bracket, and those are real estate investment trusts, some foreign equities, that kind of thing. So that's treated identically to interest or wages. If you have assets or investments in this category, it's best to put them in a tax sheltered account or in a Roth account. And then finally, you have municipal bonds. They are federal tax free, often state tax free. If you're in Texas like me, everything is state tax free because we don't have a state income tax. So, woo! But they also have lower absolute yield, but are highly efficient for top bracket earners. So, what do your taxes actually look like if you're making, say, $140,000 per year gross? So, first, if you are a single filer, then you're going to probably knock off about $16,100 for your standard deduction. So, the first $16,100 you're not taxed anything on. Then the next $12,400 is taxed at 10%. So, for that amount, you're going to owe $1,240. Then after that, the next $38,000 is taxed at 12%. So you'll owe 4,560 on that. Then the next bracket is the 22% bracket. So you're going to owe $12,166 on that next 55,300. And then your top bracket, your 24% bracket's only going to have 18,200 in it, and you're going to owe 24% on that, which comes out to $4,368. So from those marginal tax brackets, you're going to owe a total of $22,334 on that 140K. You also have payroll stuff to worry about. So Social Security and Medicare, and those are taxed at a flat rate. So Social Security is going to be 6.20%. So that comes out to 8,680, and your Medicare is going to be 1.45%, which comes out to $2,030. So $10,710 total on that part of your payroll tax stuff. So when people say they are in the 24% tax bracket, they are referring to their maximum marginal rate, the tax applied only to their very last dollar. And that's important to note because their actual overall tax rate is more about 15% on that gross salary of $140,000. And this is a huge myth, and in fact, a myth that one of my employees succumbed to and refused a promotion and got a lower paying job to avoid, because this individual was convinced that if he got into a higher tax bracket, he would actually be taking home less money than before because all of his money would be taxed at that new higher rate. Totally not true. If you're making more money, you are making more money. There's not any magical torpedo that hits you when you move from the 22% bracket to the 24% bracket. The 24% bracket only applies to that very first dollar that enters that territory, and everything below that dollar is still taxed at your prior rates. So remember, your brackets, they apply marginally, and it's like a ladder. Okay? So you're not judged on the highest rung for all of the money that you make. Now, this brings us to the question of what do we do about investing in a brokerage account? Well, for me, I look at whether my investment's total return is still going to be attractive after taxes. So, for a strategy like the Dragon portfolio, or rather the Dragon Rider portfolio that I talked about in a prior video, that stacks things like managed futures and gold exposure and bonds on top of regular global market stocks. What I'd want to know is, can the cost of borrowing and the cost of, you know, taxes on ordinary income, will that overcome the tax drag that's introduced in a brokerage account? Maybe, maybe not. Don't be afraid of taxes just because they exist. What matters is what happens after you apply taxes. You want to have the best net return that you can have. Lowering your taxes for the sake of lowering your taxes, it's just not smart. I mean, you could, for instance, hold municipal bonds that are tax exempt and get a return of, say, 3% and have most of that burned up by inflation. Or you could, like I do, hold catastrophe bonds that return about maybe, 8 to 9% per year. Even if you get hacked off 3% or 4%, and that brings it down to like 5 or 6% returns after taxes, you're still getting way more than you would on those municipal bonds. So, think about that. Thank you for watching Miller Momentum. Always a pleasure. Next time, I'm going to be talking about a simplified version of the Miller Momentum flagship portfolio for those of you who may not have access to fancy things like catastrophe bonds or may not feel comfortable with having 10% in precious metals or funds like chaos, that kind of thing, who may want a much longer back test, a much longer pedigree on the portfolio. I've got all that coming up and more. So don't forget to like and subscribe. And hey, leave me a comment about something that you'd like to see covered on this channel. I'll catch you next time.